Good morning, everyone. My name is John Giordano. I'm a partner here at Citrin Cooperman, where I co-lead our firm's manufacturing and distribution practice, along with my colleague, Mark Henry. At Citrin Cooperman, our goal is to bring value-added solutions to clients through not only our core services and core competencies, such as tax compliance and financial statement assurance work, but also through our advisory practices, whether it be state, local, international tax, strategic planning, business digital services and cyber, valuation, due diligence, quality of earnings studies, or business process outsourcing. Our advisory practice has been built to give the middle market business owners access to services that larger competitors take for granted. As evidenced by today's webinar, we also like to align with subject matter experts in various different fields. As a professional service firm, whether it be accounting, legal, or just general consulting, the focus is mainly to stay ahead of the trends and be a sounding board for our clients. I think we could all agree that not since PPP have we been met with more uncertainty and challenges than the current administration's approach on tariffs. But here we are. So our goal for today is to continually monitor where things stand, potentially mitigate where practicable, and all while considering the legal and tax considerations that come along with it. To give everyone a quick run of our show today, we'll have a 30-minute presentation on the current status of the current administration's approach to tariffs, while also highlighting a few mitigating strategies that businesses could potentially consider. Giving that presentation today and guesting for us is Tom Cook. Tom is the CEO and Managing Director of Blue Tiger International. With over 30 years of experience in assisting companies all over the world manage their import and export operations, Tom is a member of New York District Export Council, Director of the National Institute of World Trade, and sits on numerous boards of various corporations varying in size. Following Tom's presentation, Tom will be joined by Russ Stern and Fred Corso to give an insight into some legal and tax implications and considerations. Fred is an international tax partner here at Citrin Cooperman in our National Tax Office. With over 25 years of professional experience working with multinational enterprises, venture capital, and private equity funds, domestic and foreign commercial enterprises, and their respective stakeholders. Another guest today is Russell Stern, joining us from Ruskin, Moscow, and Faltacek, a law firm locally here on Long Island. He serves as counsel to a broad spectrum of mature business ventures and entities, as well as an array of entrepreneurial endeavors. He is outside general counsel of several of Long Island's largest privately owned companies, for whom he provides advice and guidance on all aspects of corporate and business matters. Russ regularly represents clients in a variety of industries, including manufacturing, distribution, transportation, and logistics. So, a couple of housekeeping items. If you have questions throughout our webinar today, please use the question and answer function within Zoom. We do hopefully reserve about 30 minutes on the back end to address a lot of those questions, but if you populate throughout, we'll consistently monitor. And if there's opportunities to interject those questions into the presentation, we'd certainly do so. So with that, I'm going to turn it over to Tom, who's going to give us our current update on the tariff landscape.
Thank you, John, and thanks Citrin Cooperman for putting this event on. It just shows a lot about their value and the services that they provide in having an event like this, because getting information and trying to make the best of it is really everybody's responsibility here, because we have to prepare for some difficult circumstances if we're both importing and exporting in global trade today. So the main focus of the discussion is to talk about tariffs. And to get everybody on the same page, I thought we just kind of get a clear understanding of why tariffs are actually in place and what they accomplish. The primary function of the tariff is to provide revenue generation into the federal government. Just as an interesting fact, in the United States, in 1789, after the Constitutional Convention, we became the United States of America, the first government agency to be formed was actually U.S. Customs, for the purpose of collecting duty on goods coming through the border, so that was the first opportunity for the federal government to create revenue to now build the government and pay for things going forward. If you go into any customs office anywhere in the United States, over the door, they have a big sign that says First U.S. Government Agency in 1789. Other reasons for tariffs is to control trade and protectionism. We have lots of different industries here in the United States that we protect, and therefore we surcharge goods coming in that compete with those markets and so forth to try to keep an even playing field. And around the world, when we export goods, other countries do exactly the same thing to protect their certain industries that they have. And lastly, is that some governments use tariffs as a negotiation strategy, really for the purpose of influencing behavior and creating policy decisions with counterparts that they trade with. And more specifically, when we look at what Trump is doing, and obviously he's creating a tremendous amount of uncertainty and chaos, which is concerning, is that he's utilizing tariffs to influence behavior and actions on the part of the countries the United States has to deal with every day. Friendly countries like Canada or Mexico, not so friendly countries, and some of the ones that we deal with in Europe, and adversarial countries such as our relationship with China, particularly on a political and military basis. So if you ever have an opportunity to read an interesting book, Trump wrote about, I think, almost 27 years ago, a book called Art of the Deal. And the reason I mention that is because in there, he talks about his strategy in negotiation. And part of his strategy is his belief of creating a certain degree of disruption and chaos to the guy on the other side of the table that he's negotiating with. And he believes in doing so, you then create yourself a leveraged circumstance. So tying that into the exact circumstances today that he's dealing with, that's what he believes. If you send salvos out, I was in the military, and if you send salvos out, you're sending mortar fire into a particular area to determine where the enemy is and the strength of the enemy. That's exactly what's being done with all this rhetoric that's coming out of the White House. It's for the purpose of not collecting additional money coming into the Treasury, but for the purpose of getting what he's going to call fair and reciprocal trade all around the world. And the example would be if Germany sells a BMW in the United States, okay, that's manufactured in Germany, they pay a 2.5% duty rate. But if Chevrolet wanted to ship a car into Germany, the total cost would be 17.5%. So what he's trying to do is to say to Germany that, listen, if we allow your cars in a 2.5, then you have to allow our cars in a 2.5. He's not trying to raise the tariff here where just to compete with their tariff at a higher level. He's trying to get the whole world to address their tariffs and bring them into par with what the United States is. We did a study on 100 different product lines heavily imported and exported to and from the United States. And we determined that the average duty rate difference was more than 7 to 8 points in terms of what we have to pay shipping to those countries compared to what they have to pay into the United States. So theoretically, whether we agree or disagree with Trump, or we like the way he's handling this, or whether we consider it responsible or not, the idea is that he's really trying to do is create a much more fair and balanced trade with ourselves and the countries we do business with. So his rhetoric goes out in a number of different directions. And if we go back to his first administration, he went very aggressively towards China. And he put forth what was called the 301 tariffs, which still exist today. Biden actually ran on the basis he was going to eliminate the 301 tariffs, but when he got into office, he was told by the management at the Department of Commerce, the International Trade Administration, that they really needed to be kept in place. So he kept them in place. So they exist today, and that adds a 25% surcharge on about 50% of what we buy from China in the area of industrial products and consumer items. Canada and Mexico, which we have a free trade agreement, which means that things that go between the countries are supposed to be without duty and tariffs. Well, that's not actually true. Canada and Mexico has all kinds of additional tariffs on US product going into their country. The example would be that Mexico and Canada can sell their dairy products into the United States, particularly Canada. But if we sell our dairy products into Canada, there's as much as a 225% additional duty that applies. So what Trump is trying to do is two things with Canada and Mexico, which is one is get them to put more resources at the border, which they're already starting to do. Mexico has committed 10,000 additional troops. Canada has added additional resources to the border. So from that side, that's already working. And now they're negotiating very intensely I'm on the advisory committee to the Department of Commerce, and we know for sure that they're negotiating every day, and actually successful strides are being made in getting Canada and Mexico to either reduce or eliminate the tariffs on the products and services that we can sell into those countries. The whole world is up for grabs as well with this fair and reciprocal tariff. He signed an executive order about 3 weeks ago telling the Department of Commerce to give him by April 1st a summary of the trade imbalances between the United States and every country in the world that we trade with, and also to look at specific product lines and to determine what they're charging for duty coming in as compared to what the United States is charging. And appreciate, as I said before, it's pretty significantly higher in other countries. So what he wants to do is even that out across the world. He's also gone after the de minimis category. The de minimis is defined as if a company or a person brings in goods from overseas that are $800 or less in value, there's no customs clearance responsibility and therefore no obligation to pay duty on that. So he signed an executive order about a month ago saying that he was going to put a 25% surcharge on all de minimis products and have them actually customs cleared. And that became an impossibility because today, US Customs and the customs brokers all around the country that service importers service about 1.2 million transactions a day. If they were to take on the amount of de minimis business coming into the United States, it would add more than 4 million additional transactions. And there's no capacity in the customs brokerage world or the capacity at US Customs to handle that volume. So Trump had to backtrack on it. And he's gone back to the Department of Commerce and Customs and said, I want to get a revenue on this money that's coming in, these goods. I want to change the rulings and so forth. So a study is being done now, and we expect that probably towards the middle to the end of May, there is going to be a ruling that comes out. Our best expectation is that he's targeting China and that goods coming in from China will not be allowed to use the de minimis rule, or it will be moved to zero, or it will be moved to around $200. That's what we're hearing from the rhetoric that's coming out of the departments responsible for that. So if you're involved in e-commerce, you need to be watching this carefully. Export controls have been increased as well, and the process to get export licenses is slowed down. Most of that is a result of the fact that so many people, both in the Department of Commerce, Departments of State, Department of Treasury, has taken that deal where they were offered to go onto retirement on an early basis, somewhere in the neighborhood as much as 30 to 80% of the senior management in those three agencies have left. In sanctions, he's increasing sanctions on all the countries in which he feels that there's an imbalance or unfair trade practices, and appreciate that that's what he's leveraging relative to trying to establish Russia's agreement to end the war in Ukraine. While we have a significant amount of sanctions, we really can do significantly more to close down their ability to sell their oil, gas reserves into the rest of the world. We know that he went after steel and aluminum. He actually did in his first administration as well. They were called the 232 tariffs, and it went after steel and aluminum in its raw and wholesale form, not as components in goods being manufactured. When Biden came into office, Biden did away with the 232 tariffs, but Trump has brought it back in. Trump has added to it that it's not just raw product and wholesale product, but also what he's referred to as derivatives, meaning that if a product contains steel or aluminum in its manufacturing process, that has to be separately declared to US Customs and duties paid on that value. Obviously, we hear in the news he's trying to establish a peace with the war in Ukraine. It appears that he's got a limited peace agreement for 30 days in terms of what both sides will or will not attack. But there seems to be a significant amount of resistance from Russia, so we'll see how that works its way out. Obviously, he created a lot of goodwill in the Hamas Israel as soon as he took office, where we got back a number of the people who were captives. There was a peace and treaty put into place temporarily. But unfortunately, in the last week and a half, it seems that the disturbance has started to increase again. One of the things that he is targeting is Iran, who is the owner of the Hamas problem, as well as other agencies all around the world, such as the Houthis in Yemen, the Hezbollah in Lebanon. Panama Canal, he's made very direct statements that he wants to take back the canal. There are actually negotiations going on. Whether that will actually happen or not remains to be seen. A U.S. company has already now bought control of the port areas at both ends of the canal, which is a positive sign. I think at the end of the day, we'll not take back ownership, but I think we'll have a lot more influence and control over what happens in the Panama Canal. He's also brought in this issue of Canada as the 51st state. There is no interest on the majority of Canadians to participate in that. So our sense is that that's probably not going to happen, and it's just rhetoric and part of his negotiation strategy on creating a fairer degree of trade. He is talking seriously about the acquisition of Greenland. If you're paying attention to it, they did a referendum in Greenland, and they did not get an overwhelming majority of people interested in selling it. But I can tell you for sure the negotiations are still going on between Denmark, Greenland, and the United States. So when we talk about tariffs, how are they calculated? We have two primary functions, and this works all over the world. It's the same kind of formula. It's a bar graph. On one side of it is where did the product be manufactured, the origin of the product, okay? Not where it's shipped from, but where was it manufactured and what it is. And customs in the United States and customs all over the world, they're not looking at the generic name of the product. What they really want to see is the harmonized tariff number, the conversion of a generic product into a 10-digit code. The first 6 digits are the same everywhere in the world, okay? And the last 4, each world can adjust to their own circumstances. That's one side of the graph. The other side is origin. Where the two meet, that's the duty rate. And the point we want to make here is that in order to impact the duty rate, if we change the origin of the goods or we change how the harmonized tariff number applies, we can then change the actual duty rate, and generally in a favorable way when we work at it. So we change the HTS, the origin, various supply chain processes or manufacturing processes, and you can impact how tariffs are applied. Obviously, I'm going to talk about some of the solutions in a moment, but the idea is that if we can change any of those areas and components of what I'm going to call the landed cost of merchandise, we have the ability to minimize what the tariff obligation will be. What we do in that process, and it's very important for all companies that sell goods internationally or import goods from foreign sources, and appreciate that in the United States, we import twice as much as we export. We look at the acquisition cost of the merchandise. And unfortunately, most importers, and I've been doing this for more than 30 years, been really literally into thousands of corporations in the United States, a lot of times their purchasing department, that's their major focus of activity, is the acquisition cost of the merchandise that they're buying from the supplier overseas. And that's an important number, but it's only one component of the landed cost. The landed cost really becomes, now we have to add in the freight charges, okay? Freight charges can be as much as 10 to 15% of the total landed cost. We have a customs clearance process that gets involved, where there's fees that are charged. Duties and taxes that are applied, and appreciate that average duties that come into the United States before these surcharges of 25% were put in place, averaged around 4.5%. So we're now in the world of as much as 29.5%. And in some products coming out of China, because he's laddering these increases, meaning they're stacking on top of one another, there are companies now that come April 2nd are going to be paying potentially as much as 60 to 65% additional duty on goods coming out of China. And lastly, is we have always our last mile delivery to our customers, how we do the distribution, where we do the distribution. These all get factored into our landed costs. So from our side as a consultant, when we look to see how we can mitigate the impact of tariffs, and appreciate the word I use is mitigate, because it's pretty difficult to eliminate tariffs, but we can impact their effect on the landed costs, sometimes so significantly that they can disappear. How we've done that in our 30-year history is we've come up with actually 19 solutions. Foreign trade zones where we manufacture and distribute from, the use of bonded warehouses, again, where we distribute from, tariff engineering, which is engineering the product to obtain a different harmonized tariff number, which will give us a lower duty rate. Drawback, which is a program that we have where if we've imported something and we paid duty or taxes on it, and now we've exported it and goods going up to Canada or Mexico or the Caribbean, which are considered exports, we can draw back that money up to 99% of what we paid in duties back from customs. Freight consolidations, meaning that we look to see how we can look at how freight is being handled and to consolidate it so you can get a better value for your spend. Intensive operations, training, and resources. I'm always amazed in some of the largest companies that we deal with that are in the Fortune 1000 category, that people in global supply chain are not really properly trained in international trade, international business, international purchasing, and logistics, so that they can apply solutions and betterments to their company's benefit. Alternative and near sourcing. Obviously, China is our largest singular market that we buy from. Canada and Mexico combined is number one. China by itself is number one, but it's number two in the looking at the USMCA agreement as number one, and then China being number two. We know that President Trump wants to create a decoupling from China. Our terminology for this is really to reduce your dependency, not to eliminate China, but really to reduce your dependency is really a better strategy. And there's lots of countries around the world, Vietnam, South Korea, Taiwan, Malaysia, the Philippines, India, Turkey, and Mexico are places that our engineering team works in moving a lot of business that's being manufactured in China outside. Sometimes the acquisition cost may be a little bit higher, but when you look at the other elements of the landed cost, the freight, the customs duties, clearance, and distribution, final distribution, we can impact many times the overall cost by 25, 30, 35%, which mitigates completely the additional surcharge of the tariff. The choice of Incoterm, Ex-Works, FOB, CIF, DDP, DAP, all these terms also impact who has responsibility and the costs that are involved both for the exporter and the importer. Utilization of technology, improving more efficient operations also can reduce the cost in the landed model. Looking to free trade agreements. The United States has 21 countries that we have free trade agreements with. The largest agreement is the USMCA with Canada and Mexico, but countries like South Korea, Singapore, New Zealand, Australia, the Caribbean Initiative Program, Dominican Republic is one of the countries that are in that. These programs allow the free movement of goods between those countries and the United States without paying duties. Comprehensive, robust landed cost modeling. All purchasing people internationally should be required by their senior management teams to create a landed cost model on all their purchasing decisions. Because at the end of the day, it's not just the acquisition cost. You have to look at all those other silos of cost in the mix. Bringing on guidance and expertise. One of the values of talking to a company like Citrin, Cooperman, a company like Blue Tiger, is that we can benchmark to like in similar companies without divulging intellectual property rights of what things can be done to the benefit of lowering those landed costs. Trade compliance management is paying attention to the import and export regulations, particularly related to what harmonized tariff numbers we're using, the valuation of the goods, our record keeping system, the documents that are required to evidence the import and export. That's all part of helping to keep the costs down. The first sale rule, this particularly relates to when we buy goods from overseas. If we buy the goods through a buying agent, okay, which in China, a lot of times we think we're dealing with the factory, but in fact, we're really dealing with a buying agent, and that buying agent is receiving a commission, we can discount the value on the invoice by the amount of that commission, okay? And sometimes when we first introduce this to the companies and they go back to their parties to get that information, they're actually amazed that in some of these cases that commission that the buying agent is getting is as much as 25, 30, 35%, which really impact dramatically what gets declared to US Customs. And lastly is HTS alterations. The harmonized tariff process of determining a harmonized tariff number has a human element to it of interpretation. And there are times that we can interpret more favorably to a different harmonized tariff number and be able to evidence that to customs and therefore obtain a lower duty rate. So I agreed with Citrin to go through a couple of case studies to show you exactly how some of these solutions work. So we worked with a company based in New York that was involved with high voltage power equipment. Their primary source of most of the components and finished products was China. Okay. When the 301 tariffs came into place back in 2017, they started to have to pay an additional 25%. Now, if they were still importing this from China, they would be paying as much as 60%, again, because of that laddering impact. Okay. So we were able to do alternative sourcing by bringing them into Mexico, and specifically in a program called the Maquiladora, which we not moved all of the manufacturing from China, but we moved a significant part of it, which created a 30% reduction on their overall landed cost modeling. And we were in the neighborhood of about $30 to $40 million of transactions to eliminate that much expense in the landed cost really impacts the effect of that additional duty charge. Overall, because every year the benefit of the maquiladora gets better because you have a lot of upfront costs when you move goods to overseas. You're creating new modeling, you're providing assistance relative to the manufacturing process. You have engineers going over to make sure things are being done. So you get a better value for it as time goes along. So we're getting now in the neighborhood as much as 50 to 75% savings in that model compared to what it was many years ago. So you appreciate the fact that in this particular model, we're always looking for improvement. So we've now created just over the border in Mexico, a foreign trade zone, which has now provided additional benefit because they do the assembly in the foreign trade zone. And we have what's called the tariff inversion from the parts and the components that come in to now a finished product. Okay, and there's a tariff shift that occurs, and the lower duty applies to the finished product, which is less than the parts and the components and raw materials that come in. Another case, we have a company down in Baltimore that's a tire equipment importer distributor. They do more than $100 million worth of business. They're a 50 years old company. They're in their third generation, family held. They have an 800,000 square foot warehouse in Baltimore, Maryland. Okay. And 90% of their finished goods are inventory, and their turnover on the imports are about 4 to 6 months. When we did an analysis in the supply chain in this particular company, we determined that one foreign trade zone might provide certain benefit. But what we did was a demographic study of their client base, and we determined that as much as 50% of their clients were west of the Mississippi as compared to east of the Mississippi. They, like a lot of companies, included freight in the cost of goods sold. So they would say, here's the price, shipping not included, shipping included in that price, not separately charged. And so they had a bill, of several $1 million of freight every year. When you look at how Federal Express, UPS works, and LTL trucking companies, okay, the further you're away from the facility, the more money you're going to pay for that transportation. Okay. So what we looked at was the opportunity to actually build a secondary warehouse. And in this case, we went to Reno, Nevada for a number of beneficiary reasons. And what we were able to do was to not only reduce their operating costs, because running a warehouse and distribution center in Reno was significantly less in terms of labor and overhead costs, insurance. Also, its closeness to the ports So instead of the goods coming directly into the port of Baltimore, they now come into the port of Los Angeles and Long Beach and being shipped up to Reno. So we were able to actually reduce their overhead costs by 30%. And because we were able to now reduce also the transportation costs, okay, we can make an impact that was several $1,000,000 a year benefit to this company just by shifting in their supply chain to a secondary warehouse. Another case was a tier 2 auto supplier that was based in Detroit, okay? And they asked us to look at reducing their landed cost. They had attended a presentation similar to this, okay? And what we did was we switched their location there, just outside Detroit, to a foreign trade zone. So instead of importing finished products, they imported components and they finished that assembly in the United States. Again, getting that benefit of deferring the duty until the goods leave the foreign trade zone, and also of tariff inversion, that the finished product had a lower duty rate than the parts and components. So we saved them on the year about $3 million against that expense. And you can see that the models really provide a significant amount of savings. And again, let me reiterate that a lot of these steps, the savings tend to step and get better each year because the ongoing costs of inception are a little bit higher. Another case study, a Florida-based manufacturer of computer peripherals. We found a contract manufacturer to replace about 50 to 60% of their imports that they were bringing in from China. So again, looking at this silos, we look at the acquisition cost, we look at the charges to ship the goods, the freight, the duties and the taxes and the customs clearance process. And when you line these two things up, and you can see in this particular example that we're taking the acquisition cost is the same between Mexico and Canada in this particular case, and this is a real circumstance, okay? But you start to see that those other silos in that landed cost model are producing significant benefits. Transactionally, they're going to save $19,000 on each transaction. And this company had 2 imports a week, okay? That's over $2 million worth of savings that they had just by shifting their goods down there. And there are other savings as well, which aren't shown here, because the cost of managing a supplier in Mexico is significantly less than the cost of managing a supplier in China. Because if you send your purchasing team or your engineering team to China for a week or 2 weeks to manage the relationship, that's a very expensive proposition. And the amount of time that you lose just in traveling to and from, as compared to going to a border crossing point in Mexico, where the maquiladora locations are located. So the last case study looking at is a Seattle-based outdoor clothing distributor. This company creates clothing all for outdoor utilization. They asked us to do an analysis to see where there might be a potential for risk and spend to be reduced. They do about $100 million worth of imports. They're paying about 6.5 to 8.5% duty, depending upon the fabric of the material and what the product, how it was described, meaning its harmonized tariff number. So what we ended up doing was to look at how they were manufacturing the product overseas and how they were selling it. And we suggested to them, one of our engineers suggested to them, that if they provide a waterproofing capability, meaning adding Gore-Tex to the manufacturing process, that would have an additional cost involved in manufacturing, but it would dramatically change the duty rate, which now went from that 6.5 to 8.5 down to 1.5%. So there was over $2 million in savings against a little over $100,000 of additional product cost. Again, looking at the total landed cost of the product by, in this case, tariff engineering, manipulating how the product is made. Oh, so I have one more case study, which is a Connecticut-based company. It exports machine tool. So the prior examples were all imports into the United States. Here's a company that was exporting. So in 2017-18, when Trump put forth the additional 301 charges, which put a 25% on goods coming into the United States, China retaliated by putting a 25% surcharge, and even in some cases, as much as 50% on products shipped from the United States into China. Their Chinese clients, which represented a big part of their business model, they said at that kind of pricing, they were unable to really buy from the US company, and they could possibly source the product elsewhere. They came to us with that problem. So our engineer team studied the manufacturing, and we actually found a German company, contract manufacturer, that could easily tool up and produce this product as well. And so they shift their manufacturing now from Connecticut to Germany, and ship the goods from Germany, so they're of German origin, so they didn't have to pay that additional surcharge in China. So the whole concept of globalization, which is still a very important factor, is now being advantaged in this situation for exports. So I've just taken about 5 of the solutions of the 19, but keep in mind that every one of those solutions has case studies and examples associated with them of how companies can benefit by using a multitude of these solutions. How we come to the decision of which solution to apply, and some this should be used for yourselves as well as thinking through the process of how I make that decision. We first do an assessment of the supply chain, and we benchmark it against like and other similar companies, again, without sharing intellectual property right issues. We then collaboratively with their purchasing team, their logistics team, their operations team, manufacturing, sales, whoever that is involved with that inbound shipment. We then create various recommendations, and the ones that we think are going to work, we create a financial model to make sure that over a 5-year period, we understand what the costs are going to be in making that change and what the ROI will be. And typically we try to work minimally that ROI is about 20 times the value of the expense. Once we determine that and we have the green light to move forward, we create the operational model, which is what does the client have to do in their manufacturing or distribution system to make those recommendations work, okay? And that becomes really the more difficult thing because generally technology has to be applied to the process to account for the products and to help us create the solution. And the last stage is implementation. And as a general statement, this will be a 60-day to as much as 120-day process when we go through this whole thing from beginning to end. So we've done ones within 30 days and ones may take it 180 days, but the average is probably in the neighborhood of 60 to 90 days. So the bottom line here is that tariffs have always been, a point of contention and issue in doing business. But when weaponizing the tariff is to cause the influence change within our trading partners, which is what Trump is really trying to do. Okay, it's not for the purpose of collecting revenue. It's for the purpose of influencing and causing these companies all around the world, kind of companies, but countries all around the world to change their policies. Okay. And in his strategy, he does it by creating this amount of chaos and uncertainty. And again, we can argue whether we like him, we don't like him, we agree or disagree. That's the methodology that he is using. We have to deal with these solutions, and we have to deal with these issues to create the solutions. So kind of in a summary format, the thing that is concerned to us is to appreciate that we believe, because we're inside of the Department of Commerce and the Department of State where these negotiations are going on, is that they're going to sort out Canada and Mexico probably within the next 30 days and bring that to where it was previously. The rest of the world is already starting to acquiesce pretty significantly. So it's going to take a little bit longer because he's dealing with some trading blocks like the total EU, but he's also dealing with countries individually all around the world. But they are talking to the United States government agencies to see what they can do to lower their duty rates with certain product lines and certain trade lanes. So our recommendation is to be cautious about this, okay, but recognize that the decoupling process from China, because of the political side of this, is more likely to be a more important factor for you to consider. Again, not to eliminate, but to reduce your dependency on China. We say to show your patience in reacting, but show aggressiveness in planning, meaning view what your options are, be ready to drop down on those actions and make them happen. But we are telling our clients mostly to wait till really the end of April, middle of May before reacting, because we see how Trump is going to be pulling back on certain of this rhetorical statements and these executive orders. And a lot of these countries are going to come to the table and do exactly what he's looking to accomplish. And lastly, as you listen to the news and you have a lot of resources coming into you, try to discern between the reality of what is being said, the rhetorical side of it, and the saber rattling, which is a big part of what Trump is doing. So with that, I will hand this back over to John and stay on the call, be available for questions.
Thanks, Tom. Appreciate you walking us through it. You know, we've worked together for the last several years, and you know, introduced you to several different clients, and having the ability to go in and take a look at the supply chain and come forth with some recommendations over the years has been a worthwhile exercise. Even if you don't react to it, it's always good to get a good assessment and somebody else, a subject matter like yourself, to get involved. So we appreciate that update. At this time, I'm going to ask Russ and Fred to join us off mute. And we'll get into our panel discussion portion of the webinar. I figured we'll give Tom a break. You know, maybe we'll start with Russ, let him catch his breath a little bit after going through all that. So one of the things I think would be informative to understand a little bit is there seems to be some question of, and I know Tom gave some background as to, you know, the source of tariffs over the years and duty, but some people are like questioning the legality of a lot of these imposed tariffs. Can you provide some insight as to how the current administration has been able to levy tariffs that they're moving through with? Because it does seem like everything's moving very fast, and there's been a lot of changes and pivots and, you know, turning on a dime. So I mean, I'm assuming it's all within the legal realm, but can you give us some background as to what really is giving them the power to do that?
Sure. Good morning. First of all, let me say good morning. Thank you to my friends and colleagues at Citrin for asking me to join today. And thank you for Tom. Thank you to Tom for his excellent presentation. I'm going to start my answer with, that's an interesting assumption. On the one hand, yes, we think there is legal validity to, certainly there's legal validity to impose tariffs. That's not the question. It's whether or not the current tariffs that are being imposed, there's validity for those tariffs. So I think we should just start with an overall premise. According to our Constitution, the Constitution gives the power to Congress alone over trade and taxation. So the right to invoke duties and tariffs has to come out of some form of legislation that's been passed. I think probably a good place to start is to start with the first Trump administration. And some of what I'm going to say very quickly is going to echo what Tom said. And then I'm going to show you the difference between the first administration and the current administration in terms of tariffs, and then some larger connections between them. So first administration, there were tariffs. They were implemented under two very, what I'll call, tried and true pieces of legislation. Your Section 232 tariffs were implemented under the 1962 Trade Expansion Act, and your Section 301 tariffs were implemented under a 1974 Trade Act. And so both of the takeaway from that is the first Trump administration was using legislation and tools that we had seen before. We may not have seen them used as aggressively as that administration used them, but there was precedent and there was an understanding. There wasn't a concern of, is this a legal place to begin with? So that begs the question, well, if they worked in the past, are the current tariffs under the same legislation, or are they somehow under different legislation? And the answer is they're being implemented under a different piece of legislation. And there is a very specific reason for that. A Section 232 tariff, there are relatively high conditions that have to be met to have these tariffs approved and implemented. Section 232's, the Department of Commerce needs to conduct a full and thorough investigation and determination and come to the determination that the imports in question pose a threat to national security. A Section 301 tariff, you need a finding from a U.S. trade representative that the foreign country is violating a U.S. right under a trade agreement, or that the foreign country is engaged in unjustifiable conduct that hinders or restricts U.S. commerce. Another nuance to a 301 tariff, they're only valid for 4 years. Common theme amongst both of them, they're time consuming. They don't happen with the swoop of one pen. There's investigations that have to take place to get to the end result of having a tariff. So here we are in Trump term number 2. The current tariffs are being implemented under a law that was passed in 1977, the International Emergency Economic Powers Act, often IEEPA. The law is valid. No one's questioned the authority of the law. Here's what's interesting. No president prior to President Trump has ever used the IEEPA to impose tariffs. It has been used often since its implementation, but never to impose tariffs. What does the IEEPA do? It allows the president to unilaterally declare a national emergency to address unusual or an extraordinary threat to U.S. national security, foreign policy, or economy. Once invoked, it includes the power to regulate the importation of any property, but any action taken or implemented must be used for the specific and actual national emergency at hand, and specifically not for any other purpose. Since this law came into existence, no court has ever overturned a presidential declaration of national emergency. Unlike a Section 301 tariff, once that national emergency is declared, it remains open and outstanding until there's action taken by the executive branch to no longer declare it a national emergency. The takeaway points here, extremely broad power to the presidency. No president's ever used it for tariffs. The act doesn't specifically say you cannot use it for tariffs. On the other hand, it specifically does not say that you can use it for tariffs. It says you have to identify a national emergency. So what is the national emergency that's been identified? Cartels, border, immigration issues, and narcotics. Mexico, viable arguments that those are issues that need to be dealt with. Canada, not so much, if at all. China, there's a tie on the China fentanyl side. China is a leading producer of precursor chemicals that go into fentanyl production. Interestingly, the Biden administration had entered into an agreement with China that significantly restricted their rights to export these precursor chemical compounds that are needed for fentanyl. So there's an argument there that if you're relying upon the fentanyl or narcotic argument for China, that wouldn't really hold up because that's not a national security issue that's coming through China. So I mentioned before that courts, since this law came into effect, have really never second-guessed any actions taken under IEPA. You may remember in the first administration, there was a ban on Muslims traveling that was upheld in the courts. A couple interesting points. You look at it and say, well, the law seems to give very sweeping powers. The courts have never challenged or reversed a presidential determination of national emergency. So what is the likelihood of successfully challenging these tariffs in a U.S. court? And I think there's two key things that I take away when I look at that question. Number one is, first, we have to find an argument, right? I just spent a couple minutes saying how it's a very broad-based law. No court has ever essentially reversed a presidential determination. And although we don't see specific language in the act for the implementation of tariffs, we do not see language restricting tariffs. But if you stick to the premise that the policy being implemented under IEPA has to tie directly to the national emergency, and essentially you're creating a policy to react, there is a school of thought that there is a component to the current tariffs which would actually allow a legal challenge and should, in theory, provide a victory. The current tariffs have an escalator clause, the tariffs that are in effect now. That escalator clause demonstrates, and so the escalator clause says, okay, my tariff is going to be here, and then Canada or Mexico, if you react with another tariff, I can escalate my tariff, and so on and so forth. It's a fundamental underpinning of a trade war. It's not reactionary to a national emergency. So there's an argument there. Do I think that the courts would buy into that argument? I don't think that the current landscape of the courts that we see right now would buy into that. And then you have the larger issue, which is this particular administration and executive branch have sent a clear message that they're not interested in what the courts have to say. So unfortunately, although it does appear to be that there is at least one argument to challenge the tariffs under IEPA as a result of the escalation clause, it doesn't appear that that would be successful. Other potential areas or recourse, WTO, World Trade Organization. And China has attempted this in the past. Other countries have used challenges at the WTO also. And the issue that one would find themselves in if they were to attempt to challenge this at the World Trade Organization now is the WTO would most likely, given their precedent, indicate that these tariffs, I'm going to generically call them, are problematic or have certain elements where they're illegal or should not be upheld. However, there is, like most adjudication procedures, there is a determination that is made by the tribunal, and then there is an ability to appeal that determination. However, one of the things that took place in the first Trump administration and has yet to be rectified is that the body inside of the WTO that has to hear that appeal is the appellate body. The appellate committee currently has no members. There are no members on the horizon that are going into the appellate committee. So when you appeal a judgment that's against you, in this case, China were to take action, Mexico were to take action, appeal, they get the judgment in favor of the WTO, US appeals, it's called appealing it into the void. You fulfill your procedural obligations, you file your appeal paperwork, they say we can't do anything with it, and it sits in limbo. So that's really just an overview. The question was the legalities of the current tariffs, and the very quick answer is it does appear that the IEEPA would allow the president to impose tariffs, provided that those tariffs are in response to a declared national emergency.
Yeah, so it's just interesting that if you want to call it an alternative approach to implementing these tariffs through this through these codes that you mentioned. So all I hear is that, you know, all this is happening all around us. What are our local businesses? How can they even react to this? It seems like it's such a big machine in terms of what's happening with implementing tariffs to almost weaponize it and force litigation, force negotiation with other countries. There's no means to legal ramification. I mean, Tom, working with your clients, what are some of the things that they're looking at now in terms of how they navigate these waters? What are some of the main things that you see with your companies that are that have infrastructure where manufacturing is happening overseas? For them to conduct business, it has to come into the state and get distributed to customers. And all this going on around them, it seems very unclear and uncertain. So I'm sure you're consulting with various different companies. I know you walked us through a couple case studies, but in the immediate, what are some of the things you're seeing right now?
So we anticipated this whole action of the government back in November. Trump started to create a given amount of rhetorical statements made in his interviews with the press and some of his speeches that he gave. So we told all our clients that it probably won't happen until end of February, March, April, in that time frame, and that you may want to increase your safety stock levels to 100, 200%. So a lot of companies bought significant amounts of additional inventory and brought it in. Now, what we suggested to a lot of them was to either move it into bonded or foreign trade zones, or to make their facilities bonded or foreign trade zones, so that the goods are physically in the United States, but they don't have to actually enter it into the US economy until its point of use. So they could defer their duty payment until when the goods are going to be of value to them when they sell it or use it in their manufacturing process. And a lot of companies have done that, because I would say almost 100 companies came to us to get them bonded or foreign trade zone space, which we did. So the short-term companies can still do that because there's still timeframes that's involved. And so a lot of people are now air freighting shipments into the United States to beef up that inventory, so they get it in before that April 2nd deadline. But as I said in my conversation earlier, that you need to be cautious here, because our belief is that, particularly with Mexico and Canada, that's going to be resolved, and we're going to be back to a normal trade circumstance with them. The rest of the world will remain to be seen, but we know that numerous countries have already acquiesced and are negotiating that. We have an inside track to the Department of Commerce and Department of State that's telling us that they're in the middle of these negotiations, and most countries acquiesce. So we're saying not to pull necessarily the trigger, but prepare, get yourself ready, so that if it was to happen, you can immediately move to a foreign trade zone, possibly move to a bonded location. Alternative sourcing. There's going to be countries that'll come out of this that have totally acquiesced, that will become significant sources for us to have as a trade partner. And the 21 countries that we already have free trade agreements, they're at the top of the list. So we already have a fair and equitable reciprocal trade agreement with those countries. So I think when it all sorts out, those countries will be considered in favor, no changes made. So countries like South Korea, Australia, New Zealand, the Philippines, where we have these trade agreements in, the Caribbean Initiative Program, the Dominican Republic, Guatemala as examples, Mexico and Canada. These places are places people should be looking at to see whether they can source. If you're into manufacturing, and a lot of your customers, John, that you've sent to us, we're now looking and have already created, in some cases, foreign trade zones. This is where you could move your manufacturing into a foreign trade zone environment, okay? And the first benefit is that you defer your duty obligation until when it comes out. And if there's a tariff inversion, meaning that you have a change in the harmonized tariff number from the raw material and components to a finished product, you can have savings. You can also subtract from that all the American cost of labor and overhead, quality control, technology, all these different things can be done. So you can bring in a lower cost product by using that. So those are some of the examples that it is. But I caution everybody that not to jump on any of this until they're sure of what the circumstances are, which will mature in the next 30 to 45 days.
Thank you. Let's move over to Fred for a minute. So, well, there's not a lot of, I don't think there's a lot of tax planning to be done around a lot of this. It kind of is what it is in some sense. But Tom discussed certain potential strategies whereby companies may look to alter their global supply chains and value chains. So, for U.S. multinationals, what type of considerations might this raise in your world?
Yeah, so tax follows business, right? I mean, clients come to me all the time, and a leading question is, how do I minimize my tax? I say, well, let's talk about what you do. Let's talk about where you do it and your operations, and then we'll figure out the extent to which you can minimize tax. But again, that follows the business. And in the context of the tariff discussion, we're considering really the operational flows of goods in and out of the country, and what that means economically. But underlying all of that is a supply chain, a value chain, and very often numerous legal entities that are viewed in certain ways for US federal income tax purposes, whether that be as a foreign corporation or a disregarded entity or a foreign partnership, a hybrid entity. And those entities are carrying out functions and activities. They might be procurement entities that are buying and selling. They might be involved in the manufacturing process. They might be involved in the R&D process, et cetera. And to the extent that over time, because of planning that is done around tariff considerations and thereby around sort of macro economic considerations, there may be movements of people, there may be movements of functions, movements of assets, whether those are tangible assets or intangible assets, from one jurisdiction to another. Or they may give rise to additional intercompany transactions, cash flows, revenue streams that have to be analyzed. And it's 2017 doesn't seem like that long ago, but it's becoming longer and longer ago. I guess that's the direction that time travels. But that was sort of a sea change time in tax law. So that's when the Tax Cuts and Jobs Act was implemented. And as a result of that, there was really very significant change in U.S. tax policy, particularly with respect to U.S. international taxation. And we sort of moved from a model of deferral, which is what my good old days planning used to be. We used to create nowhere income and double deductions and all these kinds of great things using tax technology. And those days are sort of largely, if not entirely, gone. And we migrated into a sort of a partial exemption system, or a partial territorial system that effectively causes all worldwide income of a multinational group to be subject to inclusion. I'm not necessarily going to say tax, but inclusion at the U.S. parent level. And that's through a number of different mechanisms. I won't bother to go into them here because I might put people to sleep. But critically, depending upon the character of the income that's earned, the gross income that's earned by different group members, and how that income is earned, and which jurisdictions are involved. So is there someone in foreign jurisdiction A, that is carrying out activities in foreign jurisdiction B, and the entity in foreign jurisdiction A gets compensated in some way? How is that income characterized for U.S. tax purposes? The answer to that question may very significantly influence the tax outcome to the U.S. parent on an annual basis and on an ongoing basis. So as there are changes to operational strategies and operational structures, those really need to be closely evaluated and understood over time as they are implemented, because again, tax follows business. It's a percentage of the results of business, right? It's not the gross number, but there could be unintended consequences to the tax to the taxpayer in the U.S. if those changes are not, which are probably going to be more invasive in nature, but if they're not properly understood.
Again, goes back to Tom's point: patience, but planning and consideration moving forward in all aspects. Obviously, like you said, the tax has to follow the business, but it's important to consider that when making any potential changes to the business and how could it impact that.
Yeah,
I
just want to repeat one thing that Tom said, and I'll say it again later on too: modeling.
Yeah. As you were going through that, Fred, a couple of things, kind of resonated with me a little bit and gave me pause to think about a few things, because, sometimes we get complacent in what we do. So I was thinking, like, a lot of companies they may have contracts with customers, contractual arrangements throughout the company that maybe there have been things that just standardly renewed every year and year, but there could be certain things within those contracts that we might want to be more in tune with. I mean, Russ, what are your thoughts on that in terms of revisiting some of the contracts you may have to see how the current environment, would play into those various different terms?
So absolutely similar to Tom's 19 strategies and knowing where you are in the process of the tariffs. We have legal strategies that we discuss with our clients. There's no great secrets. One of the first things you do, and what anybody who's involved in any type of international trade, especially right now with the affected countries, is look at the contracts that you have with your customers, whether it's your end user customer, supplier, vendor, whoever it is. And there's going to be certain things that you're going to want to look for in those contracts. So I think, probably most people on the webinar have heard of a force majeure clause in a contract. It's typically invoked. It typically addresses things like acts of God, war, epidemics. Well, epidemics and pandemics post 2000 found their way being written into force majeure clauses. Terrorism, natural disasters. In all the years I've been doing this, the couple things, the concerns for force majeure clauses, if you're thinking that's going to be my way out of here, number one, all the ones that I've seen, I can only think of a handful that actually drilled down to level of specifically mentioning tariff or duty related items. And in those cases, in every one of those deals, that was call it a hot button issue for that deal. That's why it was specifically addressed there. Said differently, the general clause isn't going to reference a tariff or a duty. And then you see another component that you run into with force majeure clauses. A lot of the times they will actually specifically exclude economic matters. So payment. The theory is a hurricane doesn't stop your ability to send money somewhere by a wire. But that is one of the things that you should absolutely be looking at. In the contracts, look for force majeure. In general, this is going to apply to the several other categories I'm going to talk about. And it's just like a primer for how courts interpret contracts, right? The first thing they're going to look at is the actual contract between the parties. Then when they're done looking at the contract, if appropriate, they will then look to the parties' prior practices and course of dealings. And all the while, they'll look for judicial precedent, prior decisions, where they try and line up the facts to apply to that. So always going to look at the contract first and the course of conduct secondarily. Talk about two other general principles to keep in mind when you're dealing with contractual analysis. There's two concepts that have developed under our body of common law. So in the US, we have common law, which is law that develops out of cases, case law. And then we have statutory or legislative law, self-explanatory. It's the laws that come down from statutes. Two theories which may be able to be invoked, very similar, just nuanced differences depending upon what jurisdiction you're in, is a frustration of purpose and impossibility doctrine. They're all going to be facts and circumstances based. And the idea is the party that is looking to either have their obligations changed or, in the most aggressive sense, terminated, have to be able to demonstrate that the underlying very core purpose, the fundamental component of consideration, can't be achieved. That there is no act that could, there's nothing that could take place that could achieve what the party's original intent was. Impossibility, you could see it's very similar, right? We may have a contract here where I agree to buy uranium from you. It's a requirements contract. You've got to fulfill all my uranium needs. We're halfway through the year, and I have an order that's coming up, and you say, there's no more supply. There's nothing I can do to force you to give me those goods. In that set of circumstances, assuming that that supply issue wasn't created by the other party, in my simplified hypothetical, the world just ran out of uranium. There's not a court that's going to turn around and say, well, you got to honor the terms of your contract. That's the idea of the frustration of purpose and impossibility. There's another very similar concept. It's called commercial impracticability. It's actually been codified by the Uniform Commercial Code that every state in the country has a version of the UCC. Most of them have adopted the standardized Uniform Commercial Code with some state nuance to it, but same basic idea, right? The party looking to have their performance modified or excused goes in and goes to court and basically says, look, under the UCC, I'm invoking the doctrine of commercial impracticability. You have to demonstrate an unforeseen contingency, rendering performance impracticable, and non-occurrence of the unforeseen contingency was a basic assumption of the contract. Go back to my hypothetical. Each party to that contract did not assume that the world was going to wake up on a Thursday and say, whoops, we're out of uranium. So those two, if you can meet those two requirements, you can make out a good argument for commercial impracticability. How is a court going to look at these arguments? Courts are generally hesitant across the board to excuse a party for performance when that party is arguing higher cost or lost profits. They look at that and say, that's an economic issue that you got yourself into. You've got to work that out. What do we think courts would do if someone went in and said, hey, these tariffs are making it impossible for me to perform my business? It's unclear, but the general thinking is I don't think that's going to be a winner of an argument if it's based just on the financial component of it. And some of the case law that we've seen develop over the years when we see these type of economic changes is the courts love to dip back to. That's exactly why we have a firm fixed price contract. That's what you should have negotiated. There is somewhere where we're seeing two instances where we see things that may open up the argument, or several instances. Courts have allowed these arguments, frustration of purpose, impossibility, commercial impracticability, when you see severe shortages or disruptions to supply chains due either to war, embargo, crop failure, natural disaster. The point there is not as a result of a action that was taken by a body, something that was essentially outside of control, adding into that mix war. Other type of clauses that you should be looking for, change in law clauses. If we were to look at cross industries in general, you're not going to see this in most industries, standard forms of contracts. You will see change of law clauses in construction contracts, real estate development contracts, and supply contracts related to those industries. And the reason why they're very prevalent there is you could be in the middle of a project and if there's a law or a zoning change, anything like it could have a significant impact on the ability to continue. So years ago, this particular industry decided that they would adopt a concept of bringing in change of law clauses into their agreements. These particular clauses don't typically provide an excuse for performance. What they do is they generally open up the door for two negotiations. They'll extend the time period to perform, or they'll open up the door for a price negotiation. This is something to keep in mind, and this is a general point. As you are looking through your contracts now, and this goes back to something that John said, how many times do we look at contracts, they auto renew, we say, I've used the same form with this customer for 10 years, you use it again. If ever there was a time, and as a corporate attorney, I'll tell you, there's a time every year we advise our clients in January, let's go through our corporate physical and see where we are, what our agreements look like, what's changed in the world. Now is a time to look at these agreements, because you are most likely not the only party in the chain of those agreements that are affected by this. So there's an opportunity here to go and open up the dialogue for a negotiation. That may be just as a result of saying, hey, we're both affected, let's figure this out. It may be as a result of analyzing your contract saying, well, this has auto renewal, but I can terminate it and then let the other party know I'm going to terminate it because I need to address this issue with you, and we'll negotiate a new contract. So just some practical points there. Two other things, and then I'll be quiet on the points of what we can do with our contractual situations. You may find a change in circumstances clause in your agreement, sometimes called a hardship clause. Again, rare. We don't see it a lot. And where you do see it, it's usually because the parties to that contract had negotiated it knowing that there is a likelihood that this event, which is out of our control, could put us in a position where we could never perform. And I think you're probably also seeing there's a theme, even though we've identified them as force majeure, change in circumstances, hardship, frustration of purpose. There's an underlying theme that the basis of the very bargain between the parties can no longer be fulfilled. So a change in circumstances, the hardship clause, where you have them, and I'll give you one example of an instance that I had last year, actually, as it directly relates to this particular administration, is if you're fortunate enough to find it in your existing agreements, or as you're renegotiating your agreements, you build it in, a well-done hardship clause would allow the party looking to either modify their performance obligations or ultimately to terminate it. If it's crafted well, it gives you both opportunities. It allows you to go to the other party and say, hey, we really have to negotiate this and figure this out. And if the answer on their end is no, then you invoke your right to terminate under the hardship clause. I mentioned I would give you one example. So I was in the process of selling a business. We began July of 24. So it's prior administration. This particular business, and they're still in business. They do DEI training for very, very large corporations. So think Marriott's of the world, Microsoft, Disney's. They work all over the globe, predominantly through webinar programs like this. Found a buyer for them. Buyer was based in Europe, negotiated our contract. And throughout the life of the deal, working in July, get through diligence. We're done by about, diligence ended around mid-September, dig into the contract September to October. And now we're sitting on the heels of the election. And all of a sudden we get a message from the other side, hey, we need a hardship clause written into the agreement that if the election goes one way and there's an impact on DEI, we need to be able to bail. And it was interesting because it played right out in front of your face as you're working on your deals in live time. The impact at the time, the administration wasn't even in place, and you can probably figure out where that deal went. That's my answer for your question about what we're currently doing with contracts and analysis and review.
After Trump's first presidency, we started to advise clients to create price escalation clauses in their contracts, where, for example, fuel surcharge has been now a very common thing that a company could pass off. If fuel changed a certain amount, you're able to put that onto the costing model. Well, the same thing we put in is that part of the surcharges could relate to tariffs as well. So that's another thing you can do legally in your contracts, to say price escalation, not only for fuel, but also for anything impacting landed costs, such as tariff.
Great point. It's a good point. It seems some of our audience members have taken some of the pressure off me, which is great. I appreciate that. There's a couple questions lingering out there. So Tom, I think most are for you. I think one of the issues, I think people seem really intrigued by the foreign trade zone. One of the questions that we have coming through is, can you expand on a little bit of the concept of setting it up? Do you need a 3PL? Can I do it with my own warehouse? What type of investment am I looking at? So if you could help, I just shed a little bit more light on that.
Sure. So a foreign trade zone in the United States is managed by two government agencies, the Department of Commerce. They have a foreign trade zone board in the International Trade Administration, and the local customs office that services the geographic area where the FTZ is located. FTZs can work in just distribution and or manufacturing and distribution. And it can be at your own facility, or it could be at a third-party facility. And in our practice, half of the new FTZs are with third parties that are setting up FTZs in their warehouses to attract companies to come in as a value add. So it's a big part of that business cycle now, is that a lot of 3PLs are getting into the business of foreign trade zones, but a company itself can set it up at their distribution or their manufacturing location as well. The primary benefit, there are two primary benefits, and then there's a couple of secondary benefits. But the two primary benefits is that when the goods come over from overseas, they pass through the border into the foreign trade zone, you're not obligated to do a customs clearance and therefore no obligation to pay duty or taxes. In a foreign trade zone, the goods can stay there on an unlimited basis. There's no time frame. And it's only once those goods come out is when the duty is obligation to be paid. And that's only if they're imported. If the goods get exported, such as going up to Canada or Mexico, there's no obligation to pay duty because the goods would never have entered the United States. Okay, so that's the first primary benefit. Secondary primary benefit relates to manufacturing. If we manufacture or assemble, and assembly is more likely in the United States rather than pure manufacturing, when we import those parts and components, there's no obligation to do a customs clearance, no obligation to pay duty or taxes. But we now create a finished product, we create what's called a tariff inversion. The tariff inversion says that we now pay the duty on what the product is now, not what it was as a component or a part or raw material. And typically in customs rulings, finished products carry a much lower duty rate than components, parts, and raw materials. So likely that tariff inversion provides a benefit in lowering the duty rate because it's changing the HTS number to a more favorable duty rate. Plus, all the costs of the assembly or manufacturing, overhead, labor, quality control, technology, quality assurance, all those different features are excluded from the price. The example I'll give, about 30 years ago, we put together the foreign trade zone for BMW in Greer, South Carolina. When you import a car from Germany into the United States that's made in Germany, there's a 2.5% duty rate. If you import tires, engine blocks, transmissions, leather, electronic components, the duty rates go from about 4.5% to as much as 12.5% duty rate. So they move all those parts undeclared to customs because they don't have to into their foreign trade zone in Greer, and they now assemble a car. So the first advantage they get is the deferral of the duty and taxes till the car comes out, and they have a 6-month cycle from when those parts and raw materials arrive to when a finished product is. So they have a cash flow advantage of 6 months. When the car comes out, say it's worth $50,000, they're going to declare it under a different harmonized tariff number at that 2.5% rate, not at the 4.5 to 12.5 of the parts and components. So you now have this tariff inversion savings. Plus, you don't have to declare $50,000. You're only going to declare $25,000 because the other $25,000 is the assembly process, labor, overhead, quality control, all the costs associated with that process. So because they're a public company, they have to put out the numbers, and they save between $4.5 to $5 billion a year in that manufacturing location where they do that work here. And just as a point of reference, almost all the major automobile manufacturers of the world do their assembly work now here in the United States in foreign trade zones. We have to go to the Department of Commerce first, get their permission to put together the foreign trade zone. Then we go to customs locally to get it actually certified. Customs doesn't charge you for their work. If you engage a company like ours, we have fees charged to help you facilitate. It's totally turnkey from beginning to actual implementation and execution. There's a local grantee who's sanctioned by the Department of Commerce, and their fees locally depend upon where they're located, and they go anywhere from about $1,500 to as much as $30,000 annually you have to pay to the grantee to set up the FTZ. The average cost in the United States is about $3,500, but there are some states that charge as much as $30,000 for them, and it depends whether you're just doing distribution or manufacturing. I would never suggest to anybody go out and try to do this independently. There are a lot of companies like ours that will help you, and it's a real good spend because we keep you out of trouble and we can facilitate all the steps. And in our case, we've been doing it for more than 30 years. So we have a fair amount of experience at it. And there are other companies like ours that do that work.
Very good. Thanks for elaborating on that. I know there's been a lot of interest in terms of further understanding those foreign trade zones. And like I said, we've worked together in the past, and you've helped us establish a couple for clients. So thank you on that. One of the things I did want to just talk to Fred about real quickly is, we do have some clients that have a parent manufacturer overseas that might ship into the US for distribution purposes and whatnot. And if we consider the tariffs and how it may affect the intercompany transaction flows, what type of consideration should be given to like transfer pricing and other intercompany charges that flow back and forth amongst those two companies?
Yeah, and just in full disclosure for everybody, I am not a transfer pricing practitioner, so I'll give you my thoughts on that. My reaction is that transfer pricing policy and the evaluation of existing transfer pricing policy, monitoring it, documenting it, is important in the ordinary course. And as things evolve, I guess is the way to put it, transfer pricing is something to really keep one's eye on. And just to take a big step back, let's think about what the objective of transfer pricing really is. If you have two independent third parties, one produces something, another one wants to buy it, and they negotiate a cost for that item, that's that. Then they're willing, unrelated parties. They negotiated the price, market carries the day, and that's the price, and that's generally going to be respected. If you have related parties, however, because they're related, there is the potential for abuse in that pricing structure that could be advantageous or disadvantageous to one jurisdiction over another. And that can be true between and amongst international relationships, so countries, and similarly amongst the states. So what transfer pricing for tax purposes seeks to do is to, where possible, with reference to comparables and other economic data, to set something that is considered to be an arm's length price for that product, that service, etc. And that has to be documented, and that has to be supported with appropriate economic analysis and other contemporaneous documentation. As matters of tariffs arise and costs perhaps go up, different parties in the relationships perhaps will bear all of the costs of those tariffs. Maybe they will agree to share in the costs of those tariffs, etc. That's going to be something that has to be understood from a contractual perspective, back to Russ's comments, but also properly documented so that it will hopefully be respected bilaterally or multilaterally between the different jurisdictions that are involved. Because failure to do that, failure to have properly documented and properly implemented transfer pricing policies can cause to double taxation of income, because one jurisdiction might assert an upward adjustment that is not respected correlatively as a downward adjustment in the other jurisdiction. And then lots of other things can happen from there. It's sort of a cascading effect. So I understand, and I should also add, if the broader environment changes, those comparables that people have been relying on, or businesses have been relying on, are going to change. So you have to update your comparable set, your data sets, to take into account the changes that are just naturally happening in the broader economic environment that affect your transfer pricing. So again, it's something that people should keep their eyes on. In the ordinary course, I would suggest that they focus even more so on it going forward. And then, I said it before, I'll say it again, model.
John,
you.
can I just add something to what he said?
Of course.
Yeah, appreciate that the IRS and the customs look at transfer pricing very differently. So there's the way you look at it from a transfer pricing, from a tax consideration, is very different than how customs looks at it, okay? And customs has a very set rule. They want the transfer price to be relevant to market pricing, okay, for that product, at a wholesale basis. Okay, and they want the FOB value declared to US Customs. Okay, but Customs employs what they call commodity specialists who specialize in all the various products that American companies buy from around the world, so that they can provide guidance on what is considered wholesale market pricing guidance. So let's say you're a US subsidiary of a German company, and the German company says, oh, you know something, we're going to be charged 25%. We'll eat that 25%, and we'll lower our invoice price to you by 25%. Customs would have a serious problem with that issue if that doesn't relate to market conditions. Okay, that 25% change. They choose to pay it on behalf of, that's perfectly fine. But the value declared to US Customs has a relationship to market value, and also the FOB value declared to them. And they look at it very differently than IRS. So companies that work international generally will have two sets of procedures or two sets of guidelines to follow. Those that relate to the tax implications and those that relate to customs implications.
I'm confused by that, Tom. Are you saying that two government agencies don't see the same thing?
We get about 35 to 40 cases a year
I'm kidding.
where customs is coming after a company because they're following the tax guidelines and not customs guidelines. Okay. And so, yeah, it does create a confusion, but the reality is anybody involved in international trade, particularly from a legal perspective, has come across this often. And the cases that we handle, these are cases where the company has gotten caught and they're being chased by customs. They're coming to us to help mediate the problem for them. Okay.
Yeah.
But yeah, there's two sets of regulations. I appreciate that. Customs now is part of Department of Homeland Security, but it has a dotted line for the collection of duties into Treasury. But before 9/11, when there wasn't a Department of Homeland Security, Customs was part of Treasury, and the IRS and Customs worked for the same agency, but they had two set of guidelines. Okay, creating that confusion. So for mega Fortune 500 companies and so forth, they have serious tax departments and serious customs departments to help facilitate the differences that are required. So you'll see two different declarations made in their accounting records, one for tax purposes and one for customs purposes.
I want to welcome my partner, Mark Henry, who co-leads the practice with me, and Mark's going to run through a few of these.
Fantastic job, and everyone, you've been incredible. Lots of questions coming in. One of them first is people asking for contact information and also just a copy of this. We'll get that out to you after the session. So make sure we'll kind of send that out as a part of our follow-up emails. But one question, I'm going to go a little bit out of order because it goes back to a topic we asked about earlier, foreign trade zones, Tom. Is there a distance limitation on making your own warehouse location a foreign trade zone, i.e. distance from port of entry of goods?
Now, foreign trade zones can be sanctioned anywhere in the United States. We've done ones in the outside of major areas in Montana, major areas in Oregon, Nevada, which they've been remote locations and so forth. The only restriction is really that they require that customs can audit those facilities on a yearly basis. And so if the distances are great, sometimes customs will require that you pay their cost of travel and a stipend for the day, traveling distances of 200-300 miles to an FTZ that's not located in a gateway location. So there's no restrictions, but there may be some additional costs that customs requires to do their job because you're pulling them where they lose a whole day in traveling or 2 days, and they have to, bear the cost of that travel. So they ask for reimbursement. But there are no restrictions for it. Bonded warehouses, which are not as robust in its offerings, they have restrictions on where they can be located in the United States, but not foreign trade zones.
Got it. And I'm not surprised we're getting so many questions there. I think with our client base, that's what we've been talking about the most so far is how to kind of mitigate some of those tariffs. Going to another one, we know about the tariffs on Mexico, Canada, and China. But as companies are considering switching suppliers to another country, what's the best way to proactively know if those countries might be subject to tariffs in the future? I know there's a level set going on, so any thoughts there? And I guess that's collectively for the group. I'll start with Tom.
If you pay attention to the statistics, 65% of the Fortune 1000 companies in the United States has a direct or an indirect interest in Mexico and Canada in manufacturing, distribution, customers, their business interests are in those locations. So we don't believe that at the end of the day, the CEOs of all those companies impacted, right? So you're talking about 700, 800 companies that are going to allow a restrictive covenant to where they've built a factory or they've built a location or a distribution center or moved production to this part of the world, Mexico or Canada. I don't think that the President Trump is going to get away with providing any restrictions on Mexico and Canada. And appreciate the fact that we're more important to Mexico and Canada than the other way around. So there are negotiations going on now. Our belief and our advice to our clients is that we believe that certainly Mexico and Canada will be resolution will be put forth. And while we may have the tariff, this 25% surcharge come in April 2nd, we don't think it's going to last for more than a month because Canada and Mexico are acquiescing to the trafficking of illegal aliens and drugs. They've already started to do that, and they are acquiescing to the reduction of duties on U.S. products coming in. So to those two countries, we just don't believe. So you can prepare for options, but we don't think you're going to need them at the end of the day. Mexico is going to be a great source for alternative sourcing. And also here in the United States, looking at the foreign trade zone as a methodology of reshoring and looking to see whether or not you can move manufacturing back here. And always keep in mind that your costs will go up when you move the manufacturing back to the United States, but your landed costs will come down. Your acquisition costs will always go up because our labor costs are so much higher, our overhead costs are much higher, but you don't have the tariffs, the shipping costs that you have when you buy from your international. So you can compete effectively in a reshoring option, particularly using a foreign trade zone. The rest of the world, it remains to be seen. He's gone after every country now. And by the end of March, he's going to announce what he's going to do with all these different countries and what he's calling fair and reciprocal trade. So as I said, a lot of countries have already acquiesced. We know the Department of Commerce is starting to create a list of countries that are already acquiescing and so forth. So I think you have to wait till probably sometime in April for the list to come out of which countries there's going to be penalties involved and which ones are going to be saved and good. We believe all the free trade agreement countries, the 21 of them, such as South Korea, Singapore, New Zealand, Australia, all the countries of the Caribbean and Central America under the Caribbean Initiative Program, Canada and Mexico, they'll be relieved of any penalties or consequences that weren't in there before Trump took office. But the rest of the world, you have to be careful about and watch. And we continue to say, prepare, look at what your options might be, talk to companies like ours, companies like Citrin. And there are a lot of companies that do what we do that's out there that are paying very close attention to this and have resources to bring to the table to help you guide this. But kind of just be a little bit patient here because I think the whole modeling of what's going to happen is going to change dramatically, as it has if you just go from January 20th to here we are on March 20th, how much it's changed. I think between March 20th and April 20th, it's going to change just as dramatically, and a lot of it's going to come back to a more normal situation.
Fred and Russell, any thoughts there? I know Tom jumped into that one in terms of diversification of suppliers and issues you're seeing, if you want to jump in.
I also think that we're nowhere near having a clear understanding of where this ultimately lands. And I could say this, if we weren't in the situation with tariffs, I said it earlier, one of the things we do with our clients is we try and get buy-in on a corporate annual check up, see where you are with your contracts, your relationships. Now more so than ever. Even though we don't know where it's going, look at your agreements. See what's in these agreements. I'll also echo something that Tom said. If we learned anything from the first administration through the Biden administration to where we are now, markets aren't as stable as they used to be. And we're seeing things being, we're often hearing the term weaponized these days. Things are being used not necessarily for their intended consequences, and they have immediate economic impact. So if there's an opportunity for you to revisit contracts and where appropriate, work in things like price escalators, it's a tool in your toolbox. And it's something that it's low-hanging fruit to take a look at right now.
Yeah, I agree. I think most clients, I have some clients that have even put it in their email threads, right? Hey, as a part of on their email thread, if there's a tariff increase, we're going to pass it along. I think that's something that's proactive that then can be negotiated, but I know a lot of clients are in that process. So that's great advice, Russell. As far as Q&A goes, anyone feel free to still pop them in, but that's all we have for now, John, if you want to hand it back to you.
So yeah, again, I want to thank Tom for joining us today. Tom, again, is the CEO and Managing Director of Blue Tiger International. And our panelist, my partner, Fred Corso from our National Tax Office, and Russell Stern, who's a partner with Ruskin Moscow Faltacek here on Long Island. We really appreciate the insight everybody has brought today. So before we part, I'll just go around the room real quick. Any parting thoughts? We'll start with you, Fred.
Like from my perspective, it's wait, watch, and see, and then react. I don't like that. Plan accordingly as things develop. But we've been seeing China +1 strategies and whatnot being implemented for years now. So good business decisions are good business decisions, irrespective of tariffs.
How about you, Russ? Any magic bullet from a legal perspective?
No, no magic bullet other than do the work, go in, look at the contracts, take a good hard look at your organization, determine where your customer concentration is, really understand what your manufacturing processes and procedures are. And look, if you're a well-run company run by professionals, those are things that you should be doing on a regular basis anyway to make your business as good as they can possibly be. But if ever there was a time to do that, now is the time to do it. We're a more global economy than we ever have been. And to echo something that Fred said, one of the things we learned from administration number 1 was be prepared to react, because you're not exactly sure where we're going to go. And I had mentioned earlier, and then I realized I never actually brought the thoughts together, how I was going to link the first administration to now and show you between the 232s and the 301s versus the IEPA tariffs, right? Tariff, common factor, been around for hundreds. What's different is have never, ever seen it under IEEPA. And now you look at it and say, well, between administration 1 and administration 2, that particular team had 4 years to figure out, however you want to describe it, what they were going to do and what their policies are. And if a group ever hit the ground running, that's what they're doing. So when we learn to react in 2000, we have to react even more now and not be sure as to where we're headed, because in admin 1, we're reacting to tariffs, but we know where they're going to go. We have precedent to see what's going to happen here. Here, first time ever using IEPA, and from one person's opinion, I think it's a pretty common opinion, it's a negotiation tactic to try and balance a trade war. And there's nothing wrong with that. Whatever we can do to make our imbalance go away and strengthen is fine. Let's just make sure that we do it during the confines of the law and with some planning. So for right now, look at your contracts, react. Eventually the dust is going to settle. Not exactly sure when.
Any final thoughts, Tom?
I just bring 2 other things into the equation, is that since Trump took office, we've now been approached by almost 60 trade associations to help their membership think out the strategies. And I know as a fact that a number of them have engaged some of the big law firms in Washington, one to lobby the Congress and Senate to move Trump in different directions. And some are contemplating these lawsuits potentially that he's gone way above and beyond the scope of his jurisdiction. And that remains to be seen whether that'll hold up or not. So if you do belong to some trade groups, you may want to talk to the organizations that run those trade groups and find out what they're doing, because you can participate. You also could reach out to your congressmen and your senators and voice out, because they are involved with this whole process that's available to you. And lastly, as Russell mentioned about looking at your contracts, look at your supply chain. Audit your supply chain. Do a robust assessment. Where you're buying from, how you're moving the goods. Look at those silos that I mentioned earlier. It's just, I think, a healthy thing to do on a periodic basis, and really see where opportunities exist. And there are lots of companies like mine and Citrin's that can help you, facilitate those kind of assessments and draw down to conclusions, so you can prepare to make any changes necessary as this whole occurrence of what Trump is doing matures.
Great. Once again, thank you, Tom, Fred, Russ. Most importantly, thank you to all of our attendees today. And my co-practice leader, Mark Henry, for joining us. As mentioned, we will get the deck out to everybody as well as everybody's contact information, but feel free to contact your Citrin Cooperman professional if you have any questions. And thank you again. Enjoy the rest of your day.